Hey people, salams, welcome back to the channel. Hope you're well and in good health. Okay, right now we're on raisin.co.uk. We're taking a look at this article about the best way to invest £100,000. That's 100k. So let's go down here. So it talks about, for example, if you've recently inherited money, received a redundancy package, or have freed up some cash to make an investment. One of the questions people think about is how can they invest 100k if they actually have 100k. So the good news is there's plenty of ways you can potentially get a good return on that 100k. So this article explores how and where and what to do potentially with that. But please do bear in mind, it's not financial advice. Always do your own due diligence. This video is only for educational and entertainment purposes. Okay, so this article talks about key takeaways. So some of the best ways to invest 100k include investing in things like property, stock market, and other annuities and so on. So expert advice. So one of the things one can do is seek professional financial advisors, seek them out and get some professional advice on how one can build an investment portfolio, looking at various elements around risk appetite and also various risk and compliance issues. Investing safely. So obviously invest something where you've got a good chance. So it could be low risk, or if you're more, daring, you might want to go into a high risk. But obviously, bear in mind that if you do go into something that's high risk, you can actually lose all your money. So it's important to make sure that you go into something where it's protected by various different bodies and so on. So you've got to research and you've got to understand what you're investing into before you actually invest, so you're better positioned not to actually lose your money. Okay, so if you found yourself in a rather nice position of having 100k to invest, there are things to consider and think about when looking to invest. So start off with getting good financial advice and looking at what the worthwhile returns might be with that kind of money. So you look at assets. So what's an asset? An asset is anything of value that can be converted into cash. This could range from a share in a company to home goods such as a TV. So both businesses and individuals have assets which in turn contribute to their financial health. For example, there might be a entrepreneur who owns a property which they have out on rent. That would be an asset. And also looking at net worth of a person or business. So an asset typically generates income, particularly in the form of property, stocks, or shares. So for example, in the example I gave about property, you may be generating income through renting. So that's a good asset which generates income. So if you're wondering how to go about investing that 100k, there are a few things you can think about. So the investment vehicle, different products, and the investors might want to put their money in where they can get positive returns and more cash. So another name for an asset in simple terms is basically somewhere to put your money which should earn you even more money, driving your earnings forward, so building your wealth over time, helping you create or move towards more the generational wealth kind of element. But how do you know what to do with it? So there are a few different places where you can look at putting this money into. So to determine the best asset to invest in, you need to think about how much return you could get or generate over time and the risk factor around the investments. So stocks, property, shares, taking a part in a partnership of a business, getting equity, that kind of stuff. So let's take a look here. So you've got, on this example in this article, you've got property, cash, stocks, peer-to-peer lending, equity, bonds, and annuities. So property, so I'll give you a personal story. So basically, as a property investor myself and a landlord, having purchased properties in the past, properties can be something which, when done correctly, you got to look at, for example, where you're buying, the price that you're buying at, and the potential return on investment. So in the UK right now, certain towns, certain places in the north, for example, you can get a property between 60 to maybe over £200,000. So the lower end is where you might find more deprived areas where there might be local council municipal schemes where you have to get a license as well. So you have to watch out for licensed areas, and you can purchase properties between different prices based upon the area. So for example, if you buy a property for 100k, in this example we're looking at investing 100k, you could buy a property for 100k, and then you could potentially rent it out. So it could be like a two-bedder. You could rent it out, let's say, for 1,000. So you're making, £1,000 a month. So that's good returns there in terms of, over an annual period. Now, it might be less. You might be in a more less affluent area. You might only be getting 600 or 700 a month. As long as you've invested in an area where you're looking at potential appreciation of the asset, so in this case, the property. So over time, you'll get capital appreciation. So the value of your home will go up. And then, if you're getting a rent as well coming in on a monthly basis, then you're generating income. That's quite a good investment there. So property is seen as one of the safest investments in the UK, especially in the buy-to-let market, which I just gave an example of, and a story I told you about my personal antidote. So while the returns that landlords and developers get from their property is usually not related to investment markets, it doesn't mean they are entirely risk-free. This is because the housing market is still subject to price corrections and crashes. So previously there was a crash in 2008, which caused a lot of issues around the world. So that was a global financial crisis. So, some financial experts do warn that house prices can slump and go down, especially following the recent sharp rise in interest rates going up all over the world and here in the UK as well. So as well as this, that's something that you need to be aware of if you are purchasing an asset on debt, or if you're borrowing money, or something like that. So you also need to offset your earnings against any capital gains tax, income tax due as a result of your investments in your property. Also, if you buy a property, you might want to consider buying it within a corporate kind of context, so buying it through a company, and then you can look at the corporation tax around that, and then buy to let tax relief decrease. Investing in property may only provide optimum returns when you have next to no mortgage. Basically, if you're buying cash outright, so for example, if you had 100k cash and you bought a property for like 80k, 90k, then that would be a lot more valuable than having to buy on debt and get a mortgage, high interest rates that could then obviously half of that money is going towards paying mortgage off and so on. Okay, so cash is often the first thing that comes to people's minds when they think about investing. So to make your money work hard for you in a savings account, people put their cash in and then they get interest. Personally, I don't take interest because of religious reasons, but there are people who will put their money into accounts where they get high interest. Stocks. So stocks represent shares of ownership in a company. So companies usually sell shares of stocks to raise money when they want to generate capital to grow their business. They list themselves on the stock market and the stock exchange and so on. So if you're looking for places to invest, buying stocks, S&P 500, other big stocks like, for example, Apple, Amazon are well-known, popular ones. That might be good to increase wealth and beat inflation, depending on how well the company does and who you buy your stocks from and how they perform. So obviously you can keep an eye on the stocks market on a daily basis to see how the performance is happening. So if the company does underperform, then you could lose some or all of your investment. So you have to be careful in relation to that. So peer-to-peer lending, so also known as P2P, is an alternative way to invest or diversify your existing investment portfolio. This type of investment allows someone to accept a loan directly from someone else rather than taking a loan out with the bank or building society. So there are platforms out there that you could use for that. But again, this can revolve around interest as well. So you have to look at that as well. Equity. So for example, someone might want to open up a business. So you might lend them, 100k for 50% of the business, or 20% or 30%, whatever it might be. You might take a share in the business, an equity share, and then you might receive a monthly share of the profits. That could be one way to invest. So equity is the amount of money that could be returned to a company's shareholders once all assets are liquidated and debt is paid off. Investing in equity can deliver a worthwhile stream of income, but it can also go terribly wrong if you don't do your research and you get into risky ventures, and that could collapse. So again, pretty much like everything else, you got to do your due diligence. Bonds. So bonds are represented of a company or a government debt. So if the company or government issues a bond, they are issuing debt and agreeing to pay interest on the money you're lending them. Bonds typically pay an annual interest, and repaying their debt at the same time. So because of the bonds are often considered one of the safer type of investments, especially if you want to invest over short term. Obviously, governments can collapse and you are dealing with interest. So if you don't deal with interest, then this might not be for you. Annuities. So if you're looking to be safe for a certain period of time without accessing your money, you could put 100k into investing in annuities, which means you get some income basically coming from that, but you won't have any access to your cash. So that'll be a problem if you need your cash straight away or emergency, or if you want cash, you won't be able to get it out from an annuity basically. So that's one thing about that. So here's various examples of where you could potentially invest 100k. Obviously, there are issues like risk compliance, risk assessment, due diligence, interest. Obviously, if you take interest or not. Some people don't, like myself, for religious reasons, but others do. So that's something to think about. Property is one of the big asset spaces where people do invest and offset a lot of their kind of extra capital that they have, or where they want to invest something. And the UK property market has always been strong. Obviously, nowadays there are things like the UK government coming out with the Renters' Right Bill, which is affecting landlord confidence. But still, beyond that, there are still opportunities in the property real estate space when it comes to investing money into the real estate sector. Okay, people, so if you had 100k, £100,000, where would you invest it? Let us know. Drop a comment in the comment section below. Don't forget, this video is only for educational purposes and not financial advice. Always seek professional financial advice when you are looking to invest. And always remember, you can lose your money as well as make money. So, okay, people, don't forget to like, share, subscribe. Click the join button, support the channel. Catch you in the next one.